Welcome to The Deep Dive, the show where we cut through the noise of earnings season and deliver the essential insights directly to you.
Today we're looking at Enerpac Tool Group, ticker EPAC. They reported Q1 fiscal 26 earnings pre-market on December 18th.
And if you were just watching the ticker that morning, you'd think it was a complete disaster.
It was a fascinating case of market whiplash. I mean, the stock dropped big, down nearly 8.8% on really high volume.
While management was on the call framing the results as, well, essentially as expected.
Exactly. So our mission today is to break down that divergence. We need to get into the financials, understand what was happening operationally, and, figure out why management is staying so cautiously optimistic.
Okay, let's get right into it. The immediate feeling from the market was, well, pretty terrible. That 8.8% drop says investors were focused only on the short-term pain.
Yeah, they were.
So what were the headline numbers that actually fueled that sell-off?
The pain really came from a slight miss on both lines and some pretty clear margin contraction.
Right.
So starting with revenue, it came in at $144.2 million. That missed consensus by about $1.7 million.
Which is a 1% decline year over year, right? 2% organically.
That's right. So not a huge miss in absolute terms, but, the direction is what matters to the street.
And what about the bottom line?
Non-GAAP EPS was $0.36. The street was looking for $0.37, so it missed by just a penny.
Okay.
DAP EPS was the same, $0.36, which is down a bit from $0.40 last year. But the real concern for the market was profitability.
The margins.
The margins. Adjusted EBITDA margin shrank pretty significantly, dropping 120 basis points year over year to 22.4%.
So a small miss top and bottom, but bigger pressure on the margins. I mean, is that really enough to justify a nearly 9% stock drop? It feels like an overreaction.
You're hitting on the core of the issue. The market wasn't just reacting to the small revenue miss. It was focused on where that miss happened. Mm-hmm. This whole story is really about a critical mix shift inside their biggest segment, industrial tools and services, or IT&S.
Let's break that down.
Okay, so the core product sales, selling their actual hydraulic tools, the wrenches, the tensioners, that business showed really robust strength. It actually grew 4% organically.
So the main engine is still running strong.
Very strong. It even included double-digit growth in their heavy lifting technology business, the HLT unit.
And that's the high-profile stuff, right? The big infrastructure projects.
Exactly. So if their high-margin, sticky product business is healthy and growing, that should be a huge plus.
But the overall segment still contracted. So what gives?
It's because that incredible product momentum was just completely swamped by a sharp decline in their service revenue.
How sharp are we talking?
Service revenue. So the on-site maintenance, the repairs, all that, it was down a staggering 26% year over year.
26%? Wow. Where did that hit the hardest?
It was heavily concentrated in the EMEA region, specifically in the UK.
Yeah.
Management said it was a few things: slower market conditions, lower production rates, and customer consolidation, especially in oil and gas.
But they also said they chose to walk away from some business, didn't they?
They did. They mentioned they intentionally passed on some lower margin service projects, part of their strategy to streamline things.
That feels a little convenient. No, we missed. That is on purpose.
Yeah.
Is that a real strategy or just an excuse?
Well, their argument is that the services segment is usually margin dilutive to the whole company anyway. So by cutting the lowest margin work, they're protecting the overall profit profile, even if the top line takes a hit.
Still, a quarter of your service revenue vanishing is going to cause some panic.
Oh, absolutely. It created short-term panic, no question.
Let's look at this geographically then, because this mix shift seems to have played out very differently around the world.
For sure. The Americas really carried the weight this quarter. They were up a strong 5% overall.
And that was led by product growth.
Yeah, an impressive 8% growth in product revenue there really shows the momentum in infrastructure and power generation markets is real.
Okay, so the Americas are strong. What about the weak spots that drag the total number down?
That would be EMEA and APAC. In EMEA, product revenue was actually up 5%, driven by infrastructure. But that massive service drop we just talked about pulled the whole region down.
And APAC?
APAC declined 8%. That region is always a bit lumpy because of the big HLT project timing. Plus, you had the slowdowns in China and Southeast Asia.
But management did point to some bright spots in APAC, didn't they? I think I remember hearing that.
They did, yeah. India and Australia showed solid performance, and they said they fully expect APAC to get back to year-over-year growth in Q2. So they're signaling the weakness was temporary.
Let's pivot to the margins then. That was the other big trigger. Gross margin held up at 50.7%. which is fantastic for an investor.
It is. It's a premium margin.
But the EBITDA margin still fell. So where did these tariff-driven costs actually hit the P&L?
They hit directly in cost of goods sold, or COGS. Management was very clear that they had significant tariff costs flowing through inventory this quarter.
But they said they offset them, right?
They did. Operationally, they executed well. They offset the dollar cost of the tariffs with price increases and productivity improvements.
So if they offset the dollar amount, why did the margin percentage still drop? That's what I'm not getting.
Right. It's a bit confusing. It's because the tariff costs raise your COGS while the price hikes raise your revenue. So even if the dollars match, you're dividing a slightly lower profit number by a slightly higher revenue number. It just temporarily squeezes the percentage. It's a timing issue.
It sounds like an optics problem that hits hard in the short term.
It is, for now. And here's the key piece of guidance for investors. Management expects this specific tariff pressure to ease up a lot in the second half of fiscal 26.
So Q3 and Q4.
Exactly. If that happens, it removes one of the two major headwinds we're talking about.
And before we get to their strategy, let's just touch on the balance sheet, because they're relying on that strength to get through this, right?
Absolutely rock solid. Their net debt to adjusted EBITDA is just 0.3, tiny. They have $539 million in total liquidity.
That's a lot of flexibility.
It is. And cash flow was great. Operating cash flow was $16 million, almost double the $9 million from a year ago.
And they're using that cash to show confidence, too. I saw the buyback number.
Very much so. They bought back almost $15 million of stock in Q1 alone. That's a clear signal they think the stock is cheap. And they also said they have ample dry powder for M&A.
Okay, this brings us to management's bull case. The path forward. They held their full-year guidance, but they're basically asking investors to look past Q1 and focus on one thing.
Order flow. That's the whole story.
A rising tide.
Yep. Order growth outpaced revenue growth in all three regions: Americas, EMEA, and APAC. This is what's giving them the confidence that the second half of the year will look much, much better.
And they're building inventory to prepare for it. Talk about that decision.
Yeah, they intentionally built up about 15% more inventory in Q1. It's a calculated risk, you know?
To make sure they can ship against those orders.
Right. They're betting the demand is real and they don't want to get caught flat-footed. If you can't ship, those strong orders can just disappear.
So let's talk about the most important number for anyone believing this story. The full year FY26 guidance. They reaffirmed everything.
They held the line. Net sales are still guided to $635 to $655 million. That's about 1% to 4% organic growth.
And EPS.
Adjusted EPS is still $1.85 to $2. But really, the number that underpins the whole story is free cash flow.
Which they kept at a really strong level.
Exceptionally strong. $100 million to $110 million. That's the hardest number to fake. And the fact that they reaffirmed it shows a ton of confidence in their internal controls and that second half recovery.
And they aren't just cutting costs to get there. They're still investing in growth. R&D spending is up.
Yes, for the third year in a row, they're targeting nearly double the new product launches in FY26 compared to FY25. This innovation is directly tied to their strategy of going after these specialized sticky markets.
Let's get into those verticals. They talked about power generation and specifically the comeback in nuclear energy.
Yeah, this is a perfect example of their moat. They support the whole nuclear life cycle construction, maintenance, decommissioning with these highly specialized tools.
They mentioned the VOC tensioners, right?
They did. A tool that's been the industry standard for reactor pressure vessel studs for over 50 years. I mean, when you need to tighten the bolts on a nuclear reactor, you use an Enerpac tool. That is as mission critical as it gets.
And on the infrastructure side, they had a great win to talk about this quarter.
They did. The custom hydraulic bridge launching system for the Juneau Creek Bridge in Alaska.
A custom hydraulic bridge launching system. That just sounds specialized and high margin.
It is. This is for the longest single-span bridge built in Alaska since 1982. It's exactly the kind of unique engineered solution that no general tool company could ever touch.
Okay, and just quickly on M&As, they have the dry powder. Are they seeing deals?
Management sounded pretty optimistic. They said the pace and quality of deal flow have picked up. They're actively looking, but they were clear they will certainly not overpay.
So if you're an investor looking at the stock down almost 9%, what are the three key things you need to watch over the next 6 months? What's the checklist for this story to work?
Okay, 3 key watch items. First, service stabilization. We need to see that negative 26% number flatten out or get a lot better in Q2. Can their new strategies actually offset that UK weakness?
Zone 2.
Second, order conversion. Did that 15% inventory build actually work? We need to see that strong order book turn into real revenue in Q2. Confirm it wasn't just noise.
And the third one have to be tariffs.
Exactly. Third, tariff headwinds. We need to see measurable proof that the margin pressure from tariffs is easing in the second half, just like they guided. If it doesn't, the skepticism is going to get a lot worse.
So it's a classic divergence. The market is pricing in the immediate pain, and management is asking you to look at the future strength.
That's the whole ballgame. Which timeline wins out?
Which brings us to our This Is Not Financial Advice segment. If you were pitching a trade based on this call to an investment committee, what's the outrageous but plausible idea?
The thesis is simple. The market is catastrophically overpenalizing EPAC for a cyclical services downturn and controllable tariff costs. It's completely ignoring that huge free cash flow guide.
The $100 million plus.
Right. That provides a really strong valuation floor. So the trade is a long-duration, short-cycle trade.
Okay, what does that mean?
It means you simultaneously short a weak European pure-play industrial services Pure 1 with a lot of oil and gas exposure while you go long EPAC, a pair trade.
That's aggressive. What's the rationale?
EPAC's diversified, high-margin product growth gives it downside protection that the pure-play Pure just doesn't have. You're betting that EPAC's services business, which is actually margin dilutive, bottoms out in Q2.
And then the recovery starts.
Once that happens and the tariff pressure fades, the powerful product engine and that massive FCF generation will drive a sharp V-shaped recovery in EPAC stock. It should easily outperform the pure play short.
A very high conviction bet on that second half execution. Okay, to wrap up, the core takeaway here is that Enerpac is facing a mix shift challenge, not a demand collapse.
Exactly. The core engine is still strong. And here's a final provocative thought for you to chew on.
Go for it.
We saw that exceptional 27% year-over-year growth from their small, high-growth Cortland Biomed segment, their medical textile business.
Right, the non-core asset.
Given their success in other specialized verticals like nuclear and infrastructure, does the performance of this sticky non-core business suggest the company should actually pursue more of these niche acquisitions, even outside of traditional industrial tools? Is this the accidental blueprint for a future conglomerate model?
That's a fascinating question about their long-term strategy. Food for thought. Thank you for joining us for this deep dive into the Enerpac Tool Group earnings call. This has been the Deep Dive. Please remember that nothing discussed here constitutes financial advice. We'll be back soon with more insights.